Good afternoon. I'd like to call to order the April 21st, 2023 meeting of the Technical Advisory Committee on Future State Revenues. Mr. Nakamoto, can you please call the roll?
Mr. Klinger,
Here.
Ms. Kaufman,
Here.
Ms. Stevenson,
Here.
Mr. Thorley,
Here.
Ms. Walker,
Here.
Chair Schmidt.
Here. Thank you. Moving to agenda item number 2, we have our first opportunity for public comment. Public testimony under this agenda item may be presented in person or by phone or by written comment. Because of time considerations, each person offering testimony during this period for public comment will be limited to not more than 3 minutes. Is there anyone here in Carson City that would like to offer public comment? Seeing none, do we have anyone on the phone or online that would like to offer public comment?
The public line is open and working, but there are no callers at this time.
All right, thank you very much. Moving to agenda item number 3, we have approval of the November 4th, 2022 and November 29th, 2022 meeting minutes. Ms. Kaufman.
Mr. Chairman, I'd just like to point out a couple of discrepancies in the minutes. On the minutes for November 4th, my name is actually spelled incorrectly. It's Sarah on the second page. And then there is another discrepancy down below where it says Russell Guindon, Mary Walker as the designee for Margaret Levitt. I believe that should say Marvin Levitt. And then on the minutes for the November 29th meeting, it indicates that members present were Andrew Klinger. However, on the second page, it also notes him as being absent.
Okay, would someone like to make a motion to approve the minutes with those adjustments?
Mr. Chairman, I would make a motion to approve those minutes with the noted adjustments.
Okay, do I have a second?
A second.
Okay, we have a motion by Ms. Kaufman, second by Ms. Walker. All in favor, please say aye. Aye. Any opposed? All right, that motion passes unanimously. Moving on, agenda item number 4 is review and approval of revenue forecasts for selected general fund revenue sources, including taxes, licenses, fees, fines, and other revenue, along with forecasts for various tax credit programs that may be taken against certain general fund revenue sources for presentation to the forum at the Economic Forum's May 1st, 2023 meeting. And Mr. Nakamoto, would you please walk us through that?
Certainly. Thank you, Mr. Chair. Members of the Technical Advisory Committee, for the record, my name is Michael Nakamoto, Chief Principal Deputy Fiscal Analyst with the Fiscal Analysis Division of the Legislative Counsel Bureau, and I will be going through this agenda item today. For your reference and for those people who are watching over the internet, there are 5 tables that were prepared by staff for this meeting today. The members of the committee do have paper copies in front of them. Anybody who is watching the meeting online can go to budget.nv.gov/meetings/budget_division, and they will be able to get PDF copies of all 5 of these documents there. So I'll walk through them and just kind of give a brief overview of the documents that you have in front of you. The first one, called Table 1, is general fund revenues year-to-date actuals for both FY22 and FY23 through the end of March. So for a lot of the revenue sources, it's kind of different based on when they're collected. For example, for the Department of Taxation, their monthly tax revenues, it's through January just because of the way that they are collected, so it's 7 months worth of information. For their quarterly taxes, it's through the first 2 quarters. The Department of Taxation will not release information on quarterly taxes such as the modified business tax or the sales and use tax until the end of May. So we only have, at the end of March, we only had the first 2 quarters. For the Gaming Control Board, they have different schedules as well as the Secretary of State and so on. And then for many of the others, it's just based on the information that we're able to get out of the controller system through March 31st of both 2022 and 2023. You also have Table 3, which are the general fund revenue forecasts for each of the forecasters. So the agency who's responsible for collecting those taxes or fees that are part of the forecast process. Fiscal refers to the Fiscal Analysis Division of LCB, and budget is the budget division of the Governor's Finance Office. So Table 3 lists all of the forecasts that are part of the consideration for today's meeting. There's also Table 3 Difference, which is essentially those forecasts that were prepared for each of the forecasters compared to the forecasts that were presented to this body at the meeting back in late November in advance of the December Economic Forum. So it'll go through all of those and show what the differences are in those forecasts by forecasters. Then the last two, and these are the two that are probably going to have the most attention paid to them as part of this agenda item. The first is Technical Advisory Committee General Fund Revenue Forecast May 1st, 2023. This is the consensus forecast that was developed in evaluating all of the forecasts from the agency as well as the Fiscal Division and the Budget Office. The staff from the Fiscal Analysis Division and the Budget Office met earlier this week to consider all of these, and then based on our consideration of all of those forecasts, this is the consensus forecast that is being presented to you for your consideration today. And then the last one that says Difference, Technical Advisory Committee Forecast, April 21, 2023 versus November 29, 2022, is again simply the difference between this consensus forecast compared to the consensus forecast that was presented to this body back on November 29th in advance of that meeting for the Economic Forum on December 5th. So having gone through that, Mr. Chair, I will basically walk you through the Technical Advisory Committee consensus forecast and kind of go through some of the highlights of the forecast, as it were. And at your direction, I can stop for questions, or if we want to do it after every page, we can do that as well.
I think doing it after every page makes sense to me.
That works. Thank you, Mr. Chair. Again, Michael Nakamoto with the Fiscal Analysis Division for the record. So we'll start with mining tax. And if you look at the net proceeds of minerals, and especially when you're looking at the difference table, you can see a significant downward revision to both, and especially to the net proceeds of minerals tax. And the reason why the forecast has gone down by just over 70.3 million is due to legislative action that was approved very early this session. Senate Bill 126 was approved by the legislature and signed by Governor Lombardo. And basically what it did is it undid the prepayment provisions that were originally established by the legislature in Senate Bill 3 of the 31st special session. And basically what that said is for FY21, 22, and 23, mining companies were required to prepay their state general fund portion of their tax based on their estimates of the current calendar year activity. And those provisions were supposed to expire at the end of this year, meaning they would have made those payments, their estimated payment for calendar year 2023, which was reflected on the Economic Forum sheets for FY23. But the legislature chose to end those provisions early, thereby not requiring the mines to make that prepayment. So we have reduced the forecast because that prepayment was not made. The mines will still be required to pay their tax, but they will be paying it under the current law, which says they'll make it as an actual payment again in FY24 against their actual activity in 2023, which is to be deposited into the state education fund rather than the state general fund. And as a result, then the forecasts for the general fund portion of the net proceeds of minerals tax remain at zero in FY24 because that money is now going to the state education fund under current law. Next, under GL 3074, the mining gross revenue tax, gold and silver, you can see a downward revision of approximately $9.8 million compared to the November 29th forecast. And this is based on information that was provided to us by the Department of Taxation. The tax returns for this tax have come in, and they are analyzing the information and what has should be reported and what has actually been collected. And based on the information that they have, they feel that the downward revision was appropriate here based on those returns that they are seeing. Moving next to the gaming taxes, as the normal practice, the gaming taxes in this block that are being provided to you today were done by the Mr. Lawton from the Gaming Control Board. We had conversations in our office with him on some of the information that he provided. He answered some questions for us. We felt comfortable with going with that. Mr. Gortari at GFO concurred with that, and so the forecast that we have presented here for you are the Gaming Control Boards, with a downward revision of approximately $719,000 in FY23, an upward revision of approximately $1.5 million in FY24, and a downward revision of $191,700 in FY25. The Transportation Connection Excise Tax, this has an upward revision of approximately $2.3 million in FY23, $1.8 million in FY24, and about $1.2 million in FY25. Right now, if you were to go back and look at Table 1, you would see that the actual year-to-date collections are up 74.7%. It is performing very well with the increased tourism in Clark County and elsewhere. And while we don't see it necessarily keeping at that plus 74.7%, you can see that this resulted in an upward revision, just mostly because those year-to-date collections have increased, and then that goes through the forecast horizon. On the flip side of that, though, is the cigarette tax, which right now year-to-date is down 7.7%. And as we've looked at the information and just some of the other things that we've gotten our eyes on, this resulted in a downward revision of this forecast of about $9.3 million in FY23, about $8.4 million in FY24, and about almost $8.3 million in FY25. And again, I think as we've looked at it, just people are not smoking as much, and this is a not uncommon thing. This has been going on for years, but for whatever reason, year to date in FY23, the collections have really fallen off in terms of the stamps that have been purchased that would go onto the packs that are sold at retail. So at this point, I will stop to see if there are any questions. Thank you.
Any questions? Ms. Walker?
Thank you, Mr. Chairman. So the question I have is, and it deals with the flat fees, restricted slots, non-restricted slots, and quarterly fees, games. In the actuals for the current year, they're down pretty significantly. 21% for the flat fees, 17% non-restricted, and 18.6% on quarterly fees, but yet when you look at the forecast, it's pretty flat. Is there a reason for that?
Mr. Chair, through you to Member Walker, Michael Nakamoto for the record. We have Mr. Lawton from the Gaming Control Board available on the Zoom. I think I would like him to address that particular question.
Thank you.
Yeah, please go ahead.
All right, can you see and hear me?
Yes, we can.
Yeah. Hi, good afternoon. For the record, Mike Lawton, Senior Economic Analyst for the Nevada Gaming Control Board. I would imagine that the tables that Mr. Nakamoto had mentioned are updated through March 31st. So there's a lag there, and the percentages that you're showing that are down significantly, I don't believe that's the case right now. I'm going to pull up something and just read that to you. Give me a moment. Sorry for the delay. So for the restricted slot flat fees through June 2022 through April 30th, 2022, or excuse me, April 15th, 2023, the restricted flat fees are actually up 0.08%. The non-restricted slot fees are up 1.01%. And then the quarterly games fees are down 0.8%. So I just think there's a timing issue there with what you have on your sheets compared to what's actually in the controller's office through April, middle of April.
Thank you very much. Appreciate that.
You're welcome.
Any other questions? Okay, please go on.
Thank you, Mr. Chair. Again, Michael Nakamoto with the Fiscal Analysis Division for the record. I will have you turn to page 3 of each of the tables, just because page 2 is the modified business tax, and all of those will be blank because those will be revenues that are discussed by the Economic Forum at their meeting on May 1st. So on page 3, I think the ones that are worth pointing out are the under other taxes. So the first one would be the business license fee, which you can see downward revisions in all 3 fiscal years. Year to date, right now, if you were to look at Table 1, the business license fee is actually up 0.7%, but there are some pretty strong months that we're comparing against. And then the early information that we've gotten that we would be reflecting in an April update for the actuals shows a pretty significant decline year over year. So this is, I think, resulted in all of the forecasters reducing their forecasts, and not necessarily by significant amounts. The reduction is about $1.3 million in FY23 and about $1.4 million in FY24, with the largest reduction of about $2.6 million in FY25. And this is just trying to mostly calibrating against what we're seeing year to date. Similarly, with the liquor tax and the other tobacco tax, those are actually down year to date right now. The liquor tax is down 3.9%. So to actually have it come back to a minus 2.4% for FY23 has some growth in it. But because this tax has been relatively weak in FY23, I believe the forecasters all looked at it and were a little more cautious going forward. And it was mostly just an adjustment of the path based on the information that we've seen so far. And then with the other tobacco tax, it's down 1.5% right now. And then we'll actually be declining a little bit even more than that to a minus 3.6% in FY23. So the resultant impact when you take those two excise taxes together is a reduction of approximately $2.8 million in FY23, about $1.9 million in FY24, and approximately $2.8 million in FY25. And again, this is just because these taxes seem not to have been performing to the level that we had anticipated back in November. We can go through the tax credits, I believe, at the end, if that is your preference, Mr. Chair. Otherwise, I will see if there are any questions about those 3 taxes or anything else on this page.
Any questions? Ms. Walker?
Sorry, I'm the newbie. So on the HECC transfer, is that, and it's a flat $5 million, is that something that comes in at the end of the year? Or, again, what is that?
Mr. Chair, through you to Ms. Walker, Michael Nakamoto for the record. That is a portion of gaming taxes. It's an annual slot tax, I believe, that is collected by the Gaming Control Board, and there's a statutory distribution of that, and the first $5 million of the proceeds go to the Higher Education Capital Construction Fund, and that does occur at the end of the fiscal year. So that's why you don't see any money in there, but that's also why you don't see any revisions of the forecast, is because it's statutorily going to be distributed at $5 million.
Great, thank you so much.
Other questions? I think we can go on.
Thank you, Mr. Chair. Again, Michael Nakamoto for the record. On page 4 of the tables under licenses, there are a few that I think I will highlight here of some notable revisions. The first is under Secretary of State, the UCC filings, which even though right now is up year to date, this is another revenue source where there's pretty strong comparisons, and the early information that we're getting from the Secretary of State's office suggests that the revenues are decreasing through March and into April. So while we're up not 1.9% year to date, you can see the forecast is actually for a minus 1.3%. And it results in downward revisions of around $200,000 per fiscal year. Basically, I think one of the things that we observed is during the pandemic, there was an increase in the UCC filings to the Secretary of State because there was a condition for a lot of the federal stimulus, the PPP loans and so on, that a lot of businesses had to actually do certain filings in this area to get that. And so it's not something that's necessarily repeating now that a lot of those federal stimulus programs have gone away. Next, under GL 3130, commercial recordings, this is the Secretary of State registering businesses, corporations, and other entities, the annual lists, and so on. Year to date, that is down 2.2%. And so that was certainly weaker than I think many of us thought at the beginning of the fiscal year or earlier in the fiscal year. So the forecast right now is for a 1.9% decrease, so a little bit of growth back, but not that much. And as that goes through the forecast horizon, it's just under $1 million a year in FY23 and 24 that would be reduced, and then a reduction of close to $1.6 million in FY25. Under the last line for the Secretary of State is GL 3152, securities. Which right now is up 5.3% year to date, but this is again another one where there's some fairly strong comparisons going into the last several months of the fiscal year, and so the end result is an increase forecast of only 1.7%. Nonetheless, I think the forecasts before were actually slightly negative to this, so we're not going to pick up that entire 5.3%, but there is an increase in the forecast here of approximately $1.7 million per year in FY23 and 24, and for that matter in FY25 as well. It's just taking that and kind of growing it into the base. The last one that I think is worth pointing out in under licenses is the athletic commission fees. It's the very last line under total licenses, GL 3102. These are the fees for unarmed combat that are collected by the athletic commission on things like boxing, mixed martial arts, and so on, right now, which are down about 30.5%. And this is one that is event dependent, so every time that there's a UFC card down in Las Vegas or a boxing match or some other kind of event of this magnitude, we receive money based on the admissions price of those. And so right now, it does not seem that they have been performing. Not that the events aren't happening, but just based on my quick observation, UFC events happen all over the world, so they might be choosing to have them in London or Dubai or Hong Kong or somewhere else that's not Las Vegas. And so I think the collections are reflecting that. And then we had a little bit of downward revision of the forecast going out just because of the uncertainty. Not that the events aren't going to occur, but it's just a matter of where they're going to occur. And there's not a lot of predictability. They don't release these schedules that far in advance that we get a really good handle on what's happening to 2024, 2025. So there are, as you can see, revisions to all 3 fiscal years in a negative fashion. Moving to fees and fines, I'll point out divorce fees, GL 3203, that there are downward revisions to those. Through the first 8 months, this is a monthly tax that is, or a monthly fee that's collected when a divorce is filed in any of the 17 counties, and then those proceeds are remitted to the state and deposited in the state general fund. For whatever reason, and whether this is a good thing or not, in general, divorce filings are down. And people are just not getting divorced right now, and so it has caused, I think, everybody to reduce their forecasts going through the horizon. Whether things change and people start getting divorced, we don't know, but right now the trend seems to be that they are going down. Civil action fees is kind of the same story right now. Year to date, those are down 8.1%. And I guess with people not getting divorced, maybe they're suing each other less also, because those filings, it's the same thing with those collections are collected, or the fees are collected at the county level, and they're remitted to the state, and so the activity is just down. So it caused, I believe, the forecasters to reevaluate that. Going down underneath the total real estate fees is GL 3066, which is short-term car lease, which year-to-date is up 14.4%. With the increase in visitors, a lot of them flying in, and many of them choose to use Uber and Lyft, which helped the transportation connection network tax that we talked about on the first page, but a lot of them are still choosing to simply rent a vehicle. And so we're seeing those collections increase, and year to date they are fairly strong. So that resulted in most of the forecasters having an increase in their forecasts for this revenue source, just to true up with that. This GL also includes the proceeds from the peer-to-peer tax. It's a similar tax, except instead of being on rental car companies, it's through the peer-to-peer rental companies such as Turo. So it's kind of an Airbnb for a car, so you can actually rent somebody else's car and drive that around as if it were Hertz or Avis, but instead it belongs to somebody else. Those collections are combined in there, and the activity on that is included as well. So you can see revisions of that of more than $2 million in the positive direction in each fiscal year. And then the last one that is worth pointing out is GL 3271, miscellaneous fines and forfeitures. There are about 8 or 9 different agencies that just collect fees, fines, anything that aren't necessarily categorized, and they get put into this bucket here. The Economic Forum's forecasted growth back in December was at 11.9%. Year to date, we're only up 5.2%. And so while this is actually still doing better than what we had, than what the actuals were in FY22, it resulted in a downward revision just to kind of true up to that it's not performing to the level that we had anticipated. But you can see at the bottom on the difference, it's approximately $165,000 in FY23 and $250,000 in FY24 and just over $200,000 in FY25. And with that, Mr. Chair, I would be glad to answer any questions on this page. Thank you.
Questions? I had just one question looking at 3161, the real estate license, especially with the housing market shifting. It looks like that's a fairly flat forecast. I was wondering if there was any thought given to what might be changing in the real estate market there, and if that forecast seems reasonable in light of those changes.
Thank you, Mr. Chair. Michael Nakamoto for the record. I'm not going to speak for the real estate division because they did the agency forecast, or for Mr. Gortari. But in the eyes of the fiscal analysis division, when we did our forecasts back in December or back in late November as well as now, we kind of took that into account. Kind of tying in, okay, what is the real estate market doing? We actually make a request to the real estate division based just on the licenses that they're issuing, because they've got 10 or 12 different licenses that they issue for brokers and real estate offices and things like that, and kind of evaluated that just to look at where we were. And I think if you were to go look at Table 3, the difference for the fiscal analysis division, we actually pulled our forecast down to take that into account. But I think when you look at this, what we have as the consensus, it was the average of the agency fiscal and budget, just kind of to smooth that out. And the end result ended up being that there was not really a significant change to the forecast here.
Okay, thank you. If there's no other questions, I think you can go on.
Thank you, Mr. Chair. Again, Michael Nakamoto for the record. On the last page of the forecasts, under use of money and property, you can see the other repayments listed there. Again, this is the legislature, or there's been various legislative activity that has essentially given loans to various agencies from the State General Fund with a schedule for the repayment of those proceeds. The numbers that you see in here for the consensus forecast are identical to what was presented at the previous meeting. There have been no changes to the schedules on any of these. The next is interest income, and the big change that is worth talking about here is under GL 3290, Treasurer's interest income. The forecast that is being presented for your consideration today is from the Treasurer's office. Based on the information that they had with respect to the balance, the investable balance, interest rates and yields, have presented these forecasts. We had conversations, the Fiscal Analysis Division and GFO met with the Treasurer's Office staff earlier this week to go through their assumptions and the methodology and everything, and we were comfortable with what they are presenting. However, we do acknowledge that it is a significant upward revision, and it is the bulk of the upward revision to the forecast that is being presented to you today. We do have representatives from the Treasurer's Office. I believe Treasurer Conine is on the Zoom. In fact, there he is. And if there are any questions about that forecast, we would direct them or request that they be directed to him. If this is a good time to stop and do that, we can do that. Otherwise, we can go through just a couple of things under the other revenue category.
Yeah, I think let's go ahead and hear about that forecast. Treasurer, whenever you're ready.
Well, hello, everyone. Thanks so much for having us today. For the record, Treasurer Zach Conine. Just talk a little bit about the interest forecast expectations on our end. It's really a tale of two things. One, assets under management continue to be higher than were expected. Some of that is the delay in getting ARPA spend out the door. ARPA spend, unlike most other federal spend, when we make interest earnings off of it, we can use them for other purposes as opposed to the underlying source or purpose of the federal dollars. So that's helpful. Obviously, we want to get those dollars out the door so that they can help people. But in the interim, we're using them to make quite a bit of money. Additionally, most of what we invest in, as you all know, is pretty boring, right? It's treasuries and agencies, things that are directly impacted by the recent hikes in the Federal Reserve. As you know, the Federal Reserve has been in a period of pretty rapid hiking, 75 basis points, 0.75% in September, the same in November, 50 basis points in December, two more 25 basis point increases in February and March, and at least based on what we see in the markets, an expectation that at the beginning of May, there'll be another increase. So we've had rapidly rising interest rates, which is the thing we can buy. We are spending a lot more time being prepared than, say, 10 years ago in this office for those increases and are able to invest the funds that we have, which are larger, more effectively. For FY23, we can see the impact of the first and second quarter Fed rate increases on returns already generated. Second quarter earnings of $29.7 million surpasses the total earnings for each of the prior 3 fiscal year totals, and was about 2.5 times the first quarter results of 11.9 million. We expect the third and fourth quarter will continue that trend, although with a bit less of a jump. To scope it for you, much of the paper that we see providing returns in the portfolio right now is in the 4 and 5% range versus a year ago, or a little bit more than a year ago, when we were in a sub 1% range with a lot of the portfolio. Overnight rates are exceeding 4.5% versus about a year and a half ago when we were in the 0.08%, right? 8 basis points versus 450 basis points. Happy to answer any other questions, but we are simply in a different world. And so using the same methodology that we've used in the past produces these results, and we feel pretty comfortable about them.
Okay. Any questions? Ms. Kaufman.
Thank you, Mr. Chairman. So in terms of the American Rescue Plan Act dollars that are currently incurring interest, what factors did you take into consideration in terms of that starting to be utilized by the state agencies, and did you take into consideration, like, at what percentage this would be fully expended by fiscal year 2025-ish?
Thank you for the question, Treasurer Conine, for the record. So we're using projections that are coming out of the governor's finance office as far as their intended spend, and then sort of pushing those projections back when the spend didn't occur in the quarter that originally it was projected to. And so, of course, the plan is, from state perspective, to spend down all those dollars. For the most part, ARPA dollars need to be obligated by December 31st of 2024 and spent by December 31st of 2026. And the assumption in this model is that we are spending effectively on a straight line between here and there, which is what GFO, the Governor's Finance Office, is currently planning. There's some adjustment in that number, but that's a pretty fair summation.
Thank you.
Thank you.
Other questions? I think I just have one question. Given that statement about the spend down of the ARPA dollars, as we're looking at the out year, the forecast, FY 2025, would the mix of dollars on that forecast is based on then be more heavily weighted toward normal state dollars being in the bank, or is that still mostly ARPA dollars that'll be getting spent out toward the end of that period?
Treasurer Conine, for the record, that's a good question. It is a closer mix of ARPA and state dollars than, say, in the current expectation. But remember, a lot of the ARPA dollars are revenue loss dollars, which effectively get commingled with the rest of the general fund. And so, as a lot of the other revenue lines in the state continue to perform, unless there's some massive increase in spending, which is not planned for, we expect the balance to remain high. The other thing that's going to happen is that we are still dealing with a part of the portfolio that was invested in prior to interest rates rising tremendously. And so that is still burning off. And so the average yield of the portfolio will continue to rise as everything is invested at the current levels, as opposed to partially invested at the current levels.
All right. Thank you very much. If there is no other questions, I think we'd say thank you for your time, and we can move on.
It's a pleasure. Thanks for having us.
Thank you, Mr. Chair. Again, Michael Nakamoto with the Fiscal Analysis Division, for the record. Lastly, under other revenue, there are only a couple that I think are worth pointing out in this block. And the first is the expired slot wagering vouchers. That is the Gaming Control Board's forecast under GL 3047. And just based on the year-to-date activity, that revenue source is up 19.7% year to date. The Gaming Control Board thought it worthwhile to increase their forecast by about $1.7 million in FY23, about $2.1 million in FY24, and approximately $2.4 million in FY25, and that was reasonable to at least fiscal staff as well as to GFO. So the forecast that you see there is the agency's forecast. Lastly, under unclaimed property, at the very bottom, the last revenue source under other revenue, GL 3255. This is an average of the agency's budget or forecast as well as the fiscal analysis division. And so basically what you'll see, especially if you were to look at the Table 3 difference, is that there were revisions by all of the forecasters relating to unclaimed property. This, again, we had the tables and things that Mr. Ginden did at the last meeting regarding unclaimed property. This is all of the unclaimed securities, bank accounts, gift certificates, whatever, that get turned over under state law to the treasurer's office. Then the treasurer and his staff evaluate that, and they do what they are doing, and then they have their campaigns to get people to come claim their funds. And so you have the inflows of this money coming in, plus you have the outflows of people who are claiming their proceeds that are being held by the state. And as we've looked at where we were year to date through the middle of April, it looks, based on, at least for fiscal, our forecasts were that the amount of obligations that were being paid out were a little bit higher than what they had been anticipated to be. That is, the treasurer is successful through campaigns or public information of getting people to come claim their money. But on the other side, the receipts that are coming in, those seem to be a little bit down. And so the end result, I believe, is the forecast that you see here, which is a reduction of about $5 million in FY23. And then reducing by approximately $2.2 million in FY24 and about $1.7 million in FY25. And I think what that is suggesting, at least as a forecaster looking at this, is that the heavy activity in terms of the obligations coming in FY22 were perhaps more of an exception. And then when we get to 23 and 24 and 25, it gets into a little bit more of a normal pattern in terms of the inflows and outflows with respect to unclaimed property. So that results in that those negative revisions into a range of around $42 million a year, which is still, I think, a little higher than what we'd seen historically going back in FY21 and then even before the pandemic, but it's certainly lower than the $56 million that was on the sheets as the actuals in FY22. So this might be a good point to stop and see if there are any questions about anything on this page in the other revenue before I move on to the tax credits, if that is your desire, Mr. Chair.
Any questions? Ms. Kaufman?
Thank you, Mr. Chairman. So for the court administrative assessments, there's $0 amounts, and in the executive budget, the governor was recommending that court administrative assessments no longer go to the specific agencies that were identified in that statute, and were going to be put back to the unrestricted general fund appropriation, or excuse me, the unrestricted general fund. Where would that be accounted for?
Thank you, Mr. Chair, through you to Ms. Kaufman. Those, if that action were approved by the legislature, that they would go into GL 3109 under the court administrative assessments. This is the one where you have this fee that is collected, or this assessment that's collected, and a certain percentage goes to certain programs, and then another percentage goes to other programs, and then anything that is above what is legislatively approved is supposed to go to the state general fund. This is something that we usually handle as a legislative adjustment after the conclusion of session, once all of those budgets have been closed and we know how much, if any, of this revenue would be coming back to the state. general fund. If that action were approved, then we would be adding that to this section here. But until a budget is closed, that forecast remains at 0.
Okay, thank you.
Any other questions? Okay, I think you can proceed.
Thank you, Mr. Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. So the last thing that is for your consideration under tax credit programs, or is under tax credit programs, and I'll go through each one of them individually. There is one that is listed on the sheet that we are going to ask for a revision based on some information that we just received, and I'll go through that when we get to it. So the first one is the film transferable tax credits. So the film office within the Governor's Office of Economic Development is allowed to issue transferable tax credits for qualifying productions of motion pictures, television, and so on. The forecast that you see in the sheet here of minus $6 million in 23, minus 8.5 million in FY24, and minus 8 million in FY25. This is based on information that we received from the film office themselves as the administrators of the credits. So this is what they believe the credits will be worth. And so this is an increase in the amount of, actually it's a decrease in the amount of credits in FY23 of approximately almost $2.8 million, which results in a net positive. So we're issuing fewer credits, so there's more money that is available for the general fund. And then it is an increase in the amount of credits of $500,000 in FY24, which results in a decrease on the table in the amount of revenue. The economic development transferable tax credits, these were colloquially known as the Tesla and Faraday credits, going back from several years ago. You'll note that under these, there are credits eligible to be awarded in FY24 and FY25. This is as a result of actions taken by the Interim Finance Committee at their meeting on January 31st. There was an application by Redwood Materials for transferable tax credits under the provisions allowing for transferable tax credits to be issued to eligible projects with a capital investment of at least $1 billion. The GOED board approved that application, but under the provisions in statute, the Interim Finance Committee has to approve the issuance of the abatement or the tax credits, which they did at their meeting on January 31st. So this $950,000 in FY24 and $475,000 in FY25 is based on the estimates that were provided to us by GOED on the application from Redwood Materials. And so we thought that that was reasonable based on the total. It was about $2.1 million in credits that could be awarded under the application. The remaining portion of that will be shown on the sheets in FY26. But that is the adjustment that results here, is that we're now accounting for these tax credits that were approved by the Interim Finance Committee at the end of January. Under catalyst account transferable tax credits, this is the item or the tax credit that we are going to request the adjustment to what is listed here. We had previously had 0 credits in FY23, 24, and 25. The information that we were receiving from the Department of Taxation indicated that there had been some of these credits that were taken in FY23 against one of the taxes, the insurance premium tax. It turns out that that was a reporting error, and that these were not actually taken by a taxpayer against that tax. So our request is when this item and the forecasts are being approved, that it be approved instead of it being at minus $475,000, that it be approved at 0, that there will be no credits taken against this program at any point during the forecast horizon. Under Nevada New Markets Jobs Act tax credits. This is the program by which insurance companies can make qualified investments that go into certain community investments in eligible areas. This was originally approved by the legislature in the 2013 session. It was reauthorized with an additional amount of credits in the 2019 session. The forecast that you see here, the minus 24 million in FY23 and 24, and then minus 22 million in FY25. This is based on the statutory authority. It's $200 million of investments that can be taken at a 58% tax credit against the insurance premium tax. And there's an allocation of that 58% of 12%, 12%, 12%, 11%, and 11%. So what you're seeing here is the last 2 years of the 12% and the first year of the 11% to get to 24, 24, and 22 million. This is unchanged from the last forecast. And the actuals, as we've observed this program over the years that it's been in play, they hold fairly close to this. Under Education Choice Scholarship tax credits, this is the program by which businesses can make donations to education scholarship organizations who then provide grants for private schools and so forth. The forecast that you see here is based on information that the Department of Taxation has provided us with respect to the amount of credits that have been awarded or issued and awarded and taken every year. The statutory authority right now is for $6,655,000 in credits to be issued every year. The legislature has approved additional allocations in FY 20, 21, and 22 of $4,745,000 every fiscal year. And so, and because they don't have to be used all at once, the recipient of the credit has 5 years to use the credit. They don't all get used at the same time. So as we worked through information last time, we had a forecast of minus 12 million in FY23, and then minus 9,910,000 in FY24, and then the 6,655 in FY25. We worked with the Department of Taxation. They've given us information that suggests that more of those unused credits from previous fiscal years were being used in FY23. So the revision to the forecast is to increase the amount of credits taken in FY23 by $1 million and then reduce it by $1 million in FY24 just to try and true that amount up, because it's a fixed amount that's still remaining. It's just trying to determine when those credits would be used. And so this is based on the information that we have is the where we're at in terms of how that remaining bucket is going to be used. Under the College Savings Plan tax credits, this is administered by the Treasurer's Office. It allows for credits to be made for employers who make contributions to 529 college savings accounts. It's a 50% match or 50% credit against that contribution. And the forecasts that are in the sheets are unchanged. They're provided to us by the Treasurer's Office. Lastly, the Affordable Housing Transferable Tax Credits. This was originally put into place in the 2019 session, and it allows for credits to be issued against eligible affordable housing projects. It's administered by the Housing Division at the Department of Business and Industry, and the forecasts that you see here are provided to us by Mr. Acroft at the Housing Division, and it's basically an update of where they're at with the program year to date. And so the results of that that forecast is that they believe that $7 million fewer credits will be awarded, issued, and used in FY23. It was previously at $13 million, and it is now at $6 million. So if there are, at this point, I think I can stop and see if there are any questions about the tax credits, and then we can go to the bottom line after that, Mr. Chair.
All right, any questions? I just had one question about that last item, the affordable housing transferable credits. In some of these others, when there's a reduction in the credit in 1 year, we see it show up in future years. Is this limited in a way that doesn't allow that to happen, or is there a reason that it isn't carried forward into future years?
Thank you, Mr. Chair. Michael Nakamoto with the Fiscal Analysis Division for the record. There are actually statutory provisions that limit the amount of credits to $10 million in 1 year. But then if you can actually exceed $10 million in a fiscal year, but then you have to reduce in the next fiscal year. So at this point, based on the information that we were given by the Housing Division, they don't see any point where they're going to be increasing the amount of credits above the $10 million per year maximum, that they'd have to decrease it in another fiscal year.
Okay, great, thank you. I think we can go on to the bottom line.
Thank you, Mr. Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. So the bottom line in terms of the forecast that you're being presented here, before tax credits, because and we can use the table for that since we have the request for the change to the tax credit forecast, which would then affect the total after tax credits. So the forecast before tax credits for total minor general fund revenue of $952,241,322 in FY23, $950,208,561 in FY24, and $931,734,343 in FY25 would be a $37,192,135 decrease compared to what this body approved at the November 29th meeting in FY23. An increase of $55,453,279 in FY24, and an increase of $53,015,454 in FY25. And that's, again, primarily resulting from the increases to the Treasurer's interest income forecasts. So after tax credits, once you remove that $475,000 tax credit from the Catalyst account, transferable tax credit program, it results in total tax credits for FY23 of minus $49,010,663. And so then the total general fund revenue after tax credits would be $903,230,659. The totals in the tables for FY24 and 25 are still correct because there are no requested revisions. The tax credit requested revision only affects FY23. So you have a negative $52,360,550 in tax credits in FY24, minus $47,130,605 in FY25. Which would result in total general fund revenue after tax credits of $897,848,011 in FY24, and $884,603,738 in FY25. So the resulting changes to the forecast after tax credits are approximately $29.3 million in FY23. I can get you the exact amount here in a second. And increases of $55,003,279 in FY24, and $52,540,454 above the November forecast after tax credits for FY25. And with that, I'll answer any questions while I'm trying to calculate the net change for FY23.
Any questions? So I think if there's no questions, we're just waiting for final numbers so that we can put that into the form of a motion to approve the revenue forecasts.
Mr. Chair, Michael Nakamoto for the record. The revised forecast of after-tax credits of $903,230,659. I actually went the wrong direction in terms of the difference. It is a minus $28,420,101 compared to the November 29th forecast. I was subtracting it. I should have been adding that amount back because we're actually gaining revenue in that aspect. So this forecast of the $903,230,659 that we would request, or that is part of the consensus, is a reduction of $28,420,101. Thank you.
All right, thank you. With that, would someone like to make a motion? So I think I heard Ms. Kaufman with the motion and Mr. Thorley with the second. All in favor, please say aye. Aye. Any opposed? All right, motion passes. With that, we have our second opportunity for public comment. Would anyone here in Carson City like to make some public comment? Anybody online or on the phone?
The public line is open and working, but there are no callers at this time.
All right, thank you very much. With that, we will adjourn this meeting.